the CFPB established its advisory committees to provide information, analysis, operational expertise, knowledge of their communities, and feedback to inform the Bureau's work. You can find a full list of the Bureau's advisory committees on our website at consumerfinance.gov. As a reminder, the views of the CBAC members are their views. They are greatly appreciated and welcomed. However, they do not represent the views of the Bureau. Today's meeting will run from 1 p.m. Eastern and conclude at 2:15 p.m. We'll start with remarks from the Bureau's Director, Rohit Chopra, followed by remarks from the CBAC Chair, Carlos Naulon. As a reminder to CBAC members, during today's meeting, if you would like to make a comment, please use the raise hand icon and the CBAC Chair will call on you. After your comments, please lower your hand. Before you speak, be sure to unmute your line and provide your name, title, and organization. Please be sure to mute your lines when you're not speaking. I'm now pleased to pass this over to Director Chopra. Director, the floor is yours.
Well, thanks, Manny, and thanks to everyone who really helped put our session today together. I especially want to welcome our new members of the council. There's really a lot I think we have in store for this coming year, and we want to make sure that these meetings, our first meeting of this year, will really set the stage for our work we'll do together. I thought I'd maybe give a little bit of an update on where the CFPB is seeing some of the state of the markets. Obviously, the changes in the interest rate environment have been unusual for many consumers in their lifetime. Many homeowners, many households have not really lived at a time when there hasn't been low interest rates. But today they see mortgage rates much higher than before, credit card interest rates much higher than ever before, and really trying to deal with charting their future and their financial life. We recently published some of our analysis on the credit card market. Credit card market is largely dominated by the biggest issuers in the country. And we now see that there's over $1 trillion in credit card debt owed by Americans. And many of them are struggling with persistent debt. In other words, the interest that they're paying, they're not able to pay down that principal. We also see an increase in the number of consumers who are revolving on their credit card debt. And in 2022, we saw that they paid $130 billion in interest and fees. I raised the credit card market because it's one place where we'd like to see more competition coming from a broader swath of entities, including community banks, as they think about their own partnerships and how they serve their consumers. Mortgages is obviously another story of household finance today. We see that interest rates, of course, are higher. Refinancing is going down. But there's also some more texture to this. The share of cash out refinancing has also increased. We see that many people are wondering, should they even move or sell because they may not be able to have the same payment in a new home at these rates. There's lots of different challenges that people are facing with this rate environment. Now, of course, we look hard across the board, student loans, auto, others, and it's true that delinquencies have creeped up on many financial products. Some of this is a return to normal as we've recovered from the COVID-19 pandemic, but we're also looking at spots where it may be more troublesome. For example, we see big increases in the amount of auto loans owed by Americans, and some of this was driven by the increases in costs of vehicles in the past few years. Many of those loans are longer in term. They may be higher in terms of their payment to income burden, and we're trying to make sense of what does this mean really for the future. I think Part of why we're increasing our emphasis on talking to community banks is that we know community banking is still the core of relationship banking. It's not algorithmic, it's not assembly line style, and it's where an individual financial institution can actually work with a borrower even when they're experiencing problems. But of course, community banking for many years is facing a number of headwinds. Obviously, the funding advantages that the very largest too big to fail institutions is a major competitive disadvantage for community banks. We see a number of funds being stored outside of commercial banks. The CFPB has reported about how there's tens of billions of dollars being stored in non-bank payment apps used by people to transfer money. We've seen a significant amount of consumer deposits that have even migrated outside of the system, including to money market funds. So how our communities stay competitive in light of these market structure issues and policy issues needs to be high in all of our thinking. The CFPB has also increased its attention on some of the big vendors in the system. Many community banks rely heavily on a small set of core service providers. Those core service providers are in many ways the engines for how data is processed and for how much of a community bank can operate. But we need to make sure that it's community banks that are able to make clear decisions and not decisions made for them by core service providers. I want to briefly touch on something that has also been a big emphasis for the CFPB. Of course, a big focus since day one has been making sure that non-bank companies are playing by the same set of rules, that they're not getting into a game of regulatory arbitrage. But one of the trends that is really high on our radars is the advent of big tech companies that are coming into consumer finance, and especially as it relates to digital payments. Now, I think we all know banking, money, payments, these are essential pieces of our infrastructure. And without that, there really couldn't be the trade and commerce that is foundational to our standard of living. But each piece of infrastructure does not always get equal treatment from regulators. Banks, chartered banks, they're subject to supervision, regulation, and they do get benefits, but they also have to meet the needs of the community. There's also some restrictions on conflicts of interest, undue risk taking, and banks are limited to certain financial activities rather than engaging in other commercial enterprises or being just an arm of a larger conglomerate. But the way in which large tech companies have expanded into payments scrambles a lot of that logic. And many of them are trafficking huge amounts of money each and every minute between consumers. And in some ways, the US is lurching toward a system that looks a bit more like the market structure in China, where payments, point of sale, other consumer payments is becoming dominated by large tech companies and their apps. So we're doing a lot to ensure that payment systems in the household and retail context don't harm consumers. And we want to make sure that there's clear lines and rules of the road. So first, we've issued a set of supplemental orders to large technology platforms to get more information about how the agency will look at their business practices, especially with respect to their use of sensitive personal data and any issuance of private currencies. Last week, we also proposed enhanced federal oversight of non-bank companies offering payment apps and digital wallets. This proposed rule would subject those large firms to the same supervision as depository institutions. It would require that they continue to adhere to applicable funds transfer, privacy, and other consumer protection laws, and we would look to see if it's actually happening. The supervision that we're doing is increasingly in the non-bank area, but we really need the input from community banks to make sure we are spotting the right places to go. Overall, we want to make sure that the financial system is working well, that community banks and others are not getting disadvantaged by regulatory arbitrage or other unfair competitive advantages. I don't know a single community banker who doesn't want to compete, but they just want to compete fairly. So I'm really looking forward to all of our work together so we can think through all of these issues, really with an emphasis on how to make sure that we can still serve those in rural areas, not just farmers, but also rural communities, also the historically underserved areas previously redlined, but also all the emerging issues when it comes to technology and the future of community banking. So I'm sorry I went a little bit over time. I think now I will turn it over to Carlos.
Thank you, Director. I appreciate your remarks. And I'm pleased to be here with all of you today. I'd like to echo both Manny's and Director Chapa's comments and welcome you all to today's meeting. As Manny mentioned, we're joined by the members of the CFPB Community Advisory Council, and I'm privileged to be the chair. We are joined today with many of the members of the committee. I think that I want to pause a little bit and talk about the importance of the role of this committee, this council, as well as the importance of community banking. I think that we need to ensure that the director and the CFPB hear the views of institutions such as ours. In particular, should also hear the views of institutions that, like mine, that serve the underserved, but we like to say not undeserving, people in our communities. Ponce Bank, my bank, is a publicly traded bank that is managed and governed by a Latino board. We focus on the immigrant markets of New York City. We have approximately 80% of our branches in low to moderate income communities, and that presents a significant challenge because those are communities that don't have a lot of funds, live paycheck to paycheck, and are feeling the effects of today's interest rate environments. So I would like to comment a little bit on the questions of the economy and the impact that it's having. In a very general sense, what we see is that the low to moderate income community is essentially replacing the stimulus funds that they received and spent with debt. The levels of debt are increasing. The credit cards balances are increasing, and the rates that they're paying is very significant and are making a significant dent into their household net incomes that are available for living. You couple that in New York with the increasing rental environment, even though a lot of the rental properties in New York rent stabilized, you still have a significant portion of the income that's going to rent. So you have a little bit of a, I should say, quite a bit of a double whammy effect between increasing debt and increasing rental requirements. We see that as being a significant risk of our consumers. And we certainly need to make sure that consumers understand how to use the financial instruments that they have access to. We talk about not financial literacy, but financial mastery, because we don't like to tell our folks that they're illiterate. They're not. They just need greater mastery and understanding how to handle debt, understanding the value of home ownership. And there we are seeing a significant slowdown in new mortgages for home purchases. We have not seen much activity now in the refinance markets. And so the people's ability to live the American dream is certainly decreasing. And I think that that is a significant area that CFPB should be focused on. But those are my thoughts, remarks. Later, we'll talk about the payments out of the house that I think is very important. But now we need to have some comments. So, Mr. Henderson, maybe you can introduce yourself and have some comments.
And Carlos, is it okay if I just impose one little rule? It might be nice if people, before they chat, just to say a sentence about their institution, where they are. That will be helpful.
Excellent. Thank you.
Okay. Thank you, Carlos. Thank you, Director. My name is Derek Henderson. I'm from DR Bank in Darien, Connecticut. Our bank is a $500 million bank or so, and we have.
And Derek, this is totally fine. We don't see
Oh.
you on video. It's okay if you can't, but just letting you.
Yes, that's okay. I'm a little under the weather after a
No
couple
worries.
days in DC. So I apologize for that, but happy to be here and offer my support to the council and to connect on these important issues. So thank you.
Sorry to interrupt. Go ahead. I apologize.
I think that's all I have for now.
Thank you, Derek. Ms. Grenlaw, Anita?
Good morning.
Anita, are you there? Great.
Yep, sorry, I was just trying to find the button. Anita Dretlaw, President, CEO of New Market Bank in the South Metro area of Minneapolis, St. Paul. We're in 3 smaller communities, but still suburbs of the metropolitan area. Very similar thoughts that Carlos had, although we are not in a lower income area. Our customers, our communities that we serve are in a bit more of an affluent area, but definitely more debt is being taken on as the funds that were given out during the pandemic have tended to been spent now. And so more credit card debt is definitely being utilized. We also are seeing a very large decrease in mortgage originations. We have a mortgage department at our bank. We're only $180 million in assets, so relatively small, but we do have a mortgage department that did a tremendous amount of volume during the pandemic, 2020, 2021 into 2022, which has all but pretty much ceased. I mean, we have a few mortgages that we're doing each month, but it's definitely decreased. The interest rates are definitely part of that, although in our area, we have a major inventory issue as well. House prices have not decreased, so that is affecting a lot of our customers, especially first-time home buyer type customers, because they can't seem to be able to either afford the homes that are on the market, especially in light of the mortgage rates that are in the economy right now. But even when they find a home, we had one customer, for instance, that wanted to buy their first home, and it took 34 offers until one was accepted. So that has been a significant challenge, I would say, in our area. Thank you.
Thank you, Anita. Now, if we could have some comments from Mr. Hoyer, Ruth?
Good afternoon. My name is Bruce Hoyer. I'm with Belt Valley Bank. We're about an $80 million bank located in central Montana, just a single office. So I think we're probably the smallest bank on the call today. But first of all, I'd like to start off thanking CFPB, the Bureau, for um, their proposed, looking into this regulating the big tech companies and stuff that um, are competing with our banks, but basically unsupervised. And I think that would be a big help um, in the survival of the community banks. The economy in our area, what happens on the west and the east coast might happen a couple years later here. It's just a whole different thing out here. I do think that I mean, we're seeing some economic effects as far as the cost of things, and for the farmers and ranchers, their input costs, and um, like this year, the cattle income is really good. They're doing well, but the grain markets are horrible. So it's kind of it all evens out, I guess. But I think one of the biggest things looking forward is and I know that Director Chopra is fond of community banks and the relationship banking, but in all honesty, I think the CFPB needs to focus on less regulatory issues with the community banks in order to uh, keep all of them from having to merge and sell out to the bigger banks, because it's just getting to the point where we can't hardly keep up with all the changes. We're 82 million in a September, and we have 12 employees. So there's only so many hours in a day that we can help customers and help our communities and try and abide by new regulations. So, all in all, I'm honored to be on the uh, advisory board here, and I appreciate the opportunity to comment on it. And yeah, I look forward to working with you all.
Likewise, thank you very much, Bruce. Mr. Ramirez?
Bruce,
Victor?
just another shout out for me for inviting me to your branch. I think it was a year ago, and to meet some of your clients.
Well, definitely, we enjoyed it. Hope you come back sometime.
Thank you, Victor.
Oh, yeah, sure. Good morning or good afternoon to some folks. Thank you, Chairman Carlos and Director Chopra, especially for your leadership role in supporting this very important public venue to hear our perspective as community banks, but also how these issues impact the communities we do business in. So my name is Victor Ramirez. I'm Senior Vice President of CRA and Fair and Responsible Banking with Beneficial State Bank. We're a 1.6 billion bank that also happens to be a CDFI, and we have branches in California, Washington, and Oregon. But I would like to thank the community organizations who took the time to share some of these perspectives with me in preparation for this public meeting. And they included some community development organizations such as CDFI, CDCs, advocacy groups, as well as some faith-based organizations. I feel this discussion wouldn't be complete without their voices. So in terms of higher interest rates and how it's impacting mortgages and consumer loans, it's pretty evident that working families and individuals have been hardest hit with these higher interest rates that have impacted their cost of living, especially their ability to access credit. I think one of the most evident sectors is in housing, with California being one of the highest costs of housing. And when you combine that with decreasing housing stock due to investors buying out single family homes that convert into high cost rentals, many potential homeowners are developing, as one community contact called it, homeownership apathy. This issue also is cross-generational and throughout various demographics that include even young professional middle-income families that are being outpriced of the housing market, but especially LMI families that are seeking the dream of homeownership. So existing homeowners with lower mortgage interest rates, we don't see them selling their homes very soon, which further exacerbates the affordable housing stock. And they also can't refinance their homes to access their equity in order to maybe finance other acquisitions, or maybe even to finance their home, their businesses. Various community contacts also share the impact that higher interest rates are having on small business owners who need business credit to expand their businesses or just to make ends meet with inflated cost of goods. And so this gives concerns to small business owners who are turning to fintech lenders who are not regulated as they should be and could be another source of predatory and unfair lending practices. So thank you for the opportunity to provide these comments.
Let me just make, if it's okay, Carlos, a couple of comments based on what we heard. So obviously, I think you're going to see pretty consistent across the country about, you know, what we would expect in terms of decline in mortgage origination anxiety about future home ownership. To me, I think there was one or two of you who have mentioned kind of credit cards. And one of the things we have found is that overall, credit cards are, you know, they're generally well-regulated product. But there's always all sorts of issues in it. And one of the things I look at quite a bit is what are the drivers as to why consumers are borrowing more on their credit cards. Now, sometimes that's because they're experiencing some financial hardship. They want to be able to borrow more. But what's interesting is some of the data suggest that maybe they're spending it in categories that there's a little bit of pent-up demand on, including travel, hospitality, others. And for many consumers, especially in the bottom income quintiles, some of them feel more confident about their job stability. Many in certain sectors of the economy, many of them are still getting wage increases. And I think there's a question I always wonder about is, will this catch up to them in the sense of financing some of these purchases at, you know, relatively high rates in some circumstances. So I think in as much that anyone insights on why we think we are seeing some of it, certainly the higher costs has to be part of it, but there's also in some cases other dimensions like increased housing costs. So anyway, I think that's going to be an important part for us to think about as how we see where the future of consumer balance sheets is going. But Carlos, you can turn it to the next person. Sorry to interject.
Oh, we appreciate those remarks, and what I think you may want to also look at from the point of view of community banks, we're being pushed out of the credit card markets. It's very difficult for us to be competitive in that area, particularly when you also have the dominance of the Visas and the MasterCards and the very little alternative to using those rails. But Ms. Johnson, Jennifer, you have some remarks?
Well, actually, Carlos, on that point, this may be something I want you all to talk about, not necessarily today, but over this year. I think in many ways, when you look at how much credit card debt is outstanding, I really think that if there was more financial institutions that were either partnering with someone or figuring out a model that they could actually obtain some of that lending volume. There's certain ways that I think some community banks have thought about that. Some of it has involved partnerships, credit card as a service. Some have really thought about debit plus networks, using your existing debit card to be able to figure out how to monetize that. I think there's other places like different products that may be substitutes for credit cards, including you know, certain lines of credit that are attached to deposit accounts. So I really do think if you look at the state of the credit card market, and we just reported on this, sure, the target Fed funds rate has gone up, but the average credit card interest rate has gone up way further than that. And some of that is a dimension of really competition. Another piece is that, when a consumer gets in trouble on a credit card with a large issuer, I think they tend to just, they're moved to collections. Sometimes they're sued. I think when you have a relationship banking arrangement, there may be more ways to figure out solutions. And I think that could benefit consumers a lot. But I encourage you, Carlos, and the committee to think about these credit products for which having more community bank share of those loans and that interest income not only could maybe fuel sustainability, but also provide consumers with a lot of benefits too. But anyway, sorry to interrupt again.
I don't think any community banker is going to object to those comments. They're right spot on. Jennifer.
Thank you, Carlos. Thank you also to the director and the CFPB for including me in this council. I'm really honored to be a part of it. My name is Jennifer Johnson. I am with Forte Bank. We are located in southeastern Wisconsin. I am the Vice President and Chief Risk and Operations Officer. Like many of you that have been on the call, we are a very small institution, just over 300 million in assets and only 3 branches. So I echo a lot of the same comments that Anita particularly made regarding the challenge of homeownership affordability currently. Our market is more middle income where we're located, but even there, we're seeing a challenge in new purchase requests that are affordable for our customers. We are also seeing an increase in not being able to qualify for equity loans. So rates go up, not just in a purchase transaction, but also in an equity situation, whether that be a home equity line of credit or a closed-end home equity loan. And because of that, we see customers, even though they may have the equity in their homes, they're unable to qualify to access that equity in their homes. Despite that, we have seen an increase in home equity line of credit usage. We've talked a lot about credit card usage as a way to cover expenses. But for the first time in a while, we have seen an uptick in our usage on our home equity lines of credit. The one thing I did want to mention that we've not really quite touched on yet and that we're concerned about is the resumption of student loan payments. We've talked already about how home ownership affordability is a challenge, how expenses are going up, how customers are using their credit cards more frequently. We are anticipating a much more difficult qualification scenario for our consumers now that they are going to have to resume full payments on their student loan debt.
Jennifer, could I just, if it's okay, could you just say a couple sentences more about utilization on HELOCs? Are these lines that were taken out several years ago that weren't being used much? Are people seeking those lines now? Are they mostly thinking about it because they don't want to move and are using it for renovation, home improvement, or is it more as a substitute for a credit card? Any insights on that?
Ironically, I would say all of the above.
Mm-hmm.
So yes, a number of these lines are existing lines. We have customers who, we offer an attractive home equity line of credit product that there isn't a massive charge to have it. So there's no cost to the customer there really. So that allows customers to have that as an access to credit without having to worry about that cost. So yes, we're seeing an increase in usage of lines that have been in existence for a number of years. We are also seeing requests for new lines, though not as greatly as we saw them in, I would say, like the COVID era. We saw, even despite the refinances, we also saw people tapping into their equity at that point. So yeah, we are seeing in those cases. I do also think that they are turning to that usage as opposed to credit card debt, because even though the rate is higher, it's still more affordable than a credit card interest rate.
Oh, it's way cheaper than the credit card.
Right.
Even so, yeah. I think for a lot of people, they're wondering, either moving is just not going to be on the table in their mind, or they're seeing this inventory shortfall and what their neighbors did sell at and are wondering. I'm thinking about this one a lot, and I think you all should too, because this is an area, cash out refi, HELOC, it can work, but it can also, people can get into real trouble on them as well. And I think community banks have traditionally been somewhat and rightfully conservative on how to originate those, but we are seeing in our data that the share of refi that is attributed to this is just much higher. And I do expect that share to increase.
Thank you, Director. I would agree with that.
Thank you. Appreciate those remarks. Mr. Urabasa, Ignacio?
Good afternoon, everybody. Thank you for the opportunity to be here with you all. And first of all, I want to say that thank you, Director Chopra, for your introductory comments. I totally agree with what you're saying. I am glad that the CFPB recognizes some of the major issues and some of the challenges that community banks have. Certainly, we have a lot of opportunities, but we also have a lot of challenges. And I think you have recognized some of them, specifically the opportunities of having relationship banking, which is very, very important, especially on the personal type of banking that many people, especially some of our minority banks, need. I am a $675 million bank. I'm situated in Laredo, Texas, which is predominantly Hispanic. My population here is 95% Hispanic. Out of the 95% Hispanic population, probably 83 to 85% of the population speaks Spanish primarily, and I'm including some of the schools. So we are in a unique situation when it comes to the banking in the minority groups. I also like to, say that the comments that the director made about the large tech companies and the cost of technology for the community banks is critical, that we can't compete with some of the big banks when it comes to economies of scale, and that the regulations very, very much hurt us. I think somebody mentioned there that they have a small bank with 40, 50 people, and it's very, very hard to keep up with all the technology, all the new regulations, et cetera, et cetera. Specifically, you talk about the new CRA rules, 1,500 pages of CRA rules. I don't have that personnel to take care of that, or the expertise, or the way to understand the legal words that they're being used there clearly. And then we have to have the new 1071 rule on the small business loans. Those basically new HMDA reporting requirements. And then I have to audit those reports to make sure that we send them out there correctly to the Fed and the call reports. And all that has a very, very high cost to small community banks, and they really hurt us. So I'm glad that the director recognizes some of our challenges, and I'm glad that I hope that something is done to alleviate some of those issues. In spite of the fact that some of those issues do not apply to small banks because certain categories are not applied to us, I do say, though, that when examinations come, most of the time the examiners will come in and give you suggestions as best practices. And most of those best practices had to do with the large regional banks or the large banks. And they pretty much tell us that they would suggest we do a particular procedure, which is, again, costly to the small banks. As far as the economy is concerned, we're doing fairly well. Obviously, a lot of people have gotten hurt. I think somebody mentioned that the small business people are the ones that are being hurt the most. As interest rates have moved up, their payments have moved up, especially when they're financing some real estate or some small business loan. that has hurt them, and they're struggling. Some of them consumers have also struggled. Mortgage loans are down. Um, we had I belong to a NeighborWorks organization here in Laredo, and we built 4 houses, and they were market price houses in the range of about $250,000, which is about the market here in Laredo, Texas, average. And we were unable to sell them, and the lots were free and clear, and there was down payment assistance on them. Those lots, those houses took over a year to sell them because of the interest rate and because the people did not qualify because of the debt to income ratios that they had to qualify with. So, that's the kind of issues that he was a great opportunity for a moderate to low to moderate income family to move into a real nice home with a very large down payment in there, and they couldn't qualify because of their income. So that's the kind of issues that we see here. Interest rates also have caused a lot of problems with the past dues on consumer lending, and we're seeing our consumer lending ratios go up somewhat, not a lot, but somewhat. They're still kind of maxing out some of their limits, and we're seeing that I think the question was what are they using it for? Some of them are maxed out, and they're continuing to use other credit cards, so they used to for living expenses, basically. The surge that we saw during the pandemic, as deposits are being run off, they ran out of that money, and now they're using their credit cards. It's very, very simple. We depend highly on the import-export business here in Laredo because of the nearshoring and the activity that goes on in Mexico, and the exporting and the importing between U.S. and Mexico, and that has increased the volumes tremendously the past 2 or 3 years due to China. So we have benefited somewhat to that, and that has helped the economy, especially in the retail sales, to a certain degree. Affordable homes are basically non-existent. You do have to have a substantial down payment, and then again, I go back to the debt to income ratios. They have to qualify. You have to be making a lot of money to qualify for even the smallest affordable home. We're not involved in any of the Fed's virtual money transfers. We feel that the fraud is too high, and we just don't want to get involved in any of that technology right now. And that's about all I have. Thank you.
Thank you, Ignacio. That's a good segue to get into the discussions about the payment systems, and I think the questions that the agenda people have received that. But I do want to make one last comment, Director, regarding the consumer. I think the risks that the CFPB should be looking at is the AI, artificial intelligence, and its role in underwriting. And it's one thing disclosing it, but the other thing is that unless the data on which AI is based is cleansed of all of the existing biases, all the AI is going to do is going to continue to have the biases that are hurting the low to moderate income community in particular. So on the payment,
Carlos, let me just share on that. Last week, you raised this very interesting point. Last week, we unfortunately had to do an enforcement action because it was very, very severe against Citibank. They had a unlawful, deliberate discrimination against Armenian Americans. And one of the things that was part of what they did is it's common for Armenian Americans, their last names to have certain suffixes, like the ending in YAN and IAN. And so in this case, it was old-fashioned, humans were involved in disqualifying them. But one could imagine that an algorithm or artificial intelligence is also making those same exact decisions. And it's often tempting to think that, oh, the computers will just be all neutral. But of course, the data they use reflects all of our society in it. And so it is a place that we are doing a lot on. But for community banks, Carlos, I think that actually AI has a lot more implications, which is that there's going to be much more generative AI where people's voices are going to be able to be cloned, and we already see that happening. I'm sure many of you have seen extremely sophisticated scams where AI and other generative AI uses are able to impersonate your own bank to be able to collect credentials, sensitive information, to initiate wire transfers and others. So there's a lot there, and I won't go into deep detail, but it's certainly something we're devoting energy to. I think overall, I want to make sure that I mention, I believe it was Jennifer that said that the student loan payments and resumption, we got to think about all together, what are we going to do to make sure that these borrowers are navigating the system effectively so that they can get alternative payment programs that they qualify for. Many of them may even qualify for certain, they have loan cancellation for certain military service, for public service, others. The CFPB is working a lot with the loan servicers and looking at them, but I think that is going to be a quite big issue for lending going forward. And then I'll just make one more comment on household finance, which is we're seeing quite a bit of an uptick in concerns about homeowners insurance cancellations. So, the media has talked about a lot in terms of California, Florida, Louisiana, but it's happening more and more places. And the result is that we have reinsurance and insurance markets that are not able to price risk on a lot of these climate and natural disasters. So that may lead to some homeowners paying a lot more for homeowners insurance, or their mortgage servicer may have to charge force-placed insurance. So that could also soak up more income. And I know we need to turn it to payments, but Jennifer, I know I name checked you, so feel free to pipe in.
You actually mentioned something that I thought was really crucial. The student loan servicers. So I speak from personal experience now that payments are resuming, in that it is incredibly difficult to get the information you need to make the right decision about what kind of either income assistance you may qualify for, what kind of public service forgiveness you may qualify for. We've been through 3 or 4 different servicers throughout the terms of my husband's student loans. And if I, as a financial professional, am struggling to navigate the system, how much more are our customers going to be struggling to navigate that system as well? So anything the CFPB is planning to do in terms of working with and encouraging the student loan servicers to handle consumers appropriately, that would be welcome.
Jennifer, we'll share with you offline. It's a big part of our non-bank supervision program. Go ahead, Carlos. Sorry, I'm delaying us.
No, quite all right. Those are very interesting subjects that we all have a lot to say about it, and they're important. In terms of the payment system, I think that payment system is one of the last bastions of banking that are being eroded, and we need to be extremely careful about. In terms of the real-time payments, I think that my biggest concern is the lack of interoperability of all those systems. And I think that that's crucial. If you look at Latin America, you look at Europe, what they're doing with real-time payments is much more, I would say, focused and much more encouraged. In fact, in Brazil, for example, is mandated. We do a lot of cross-border payments, and when it comes to real-time payments, I think that's a necessity to have real-time cross-border payments, but that is a very difficult area to have because of, one, the interoperability, as I just said, but also because you have such disparate systems that are in effect in every one of those countries. When it comes to the Venmos and the Cash Apps, the difficulties that community banks have is that there is lack of audit trails. All you get is a message saying this is a Venmo transfer. That's all. Trying to figure that where it is, what it is for, etc., is very difficult. Also the expectations of the customers, the consumers, are such that Regulation E kind of applies to it, but because of the controls that exist, and I would say that the oligopoly that exists, there's very little that a bank like us, even though we're not that small, can have in terms of dealing with the larger institutions who will just reject payments and that essentially say, go ahead and sue me. Well, that's a very difficult process. So what you end up doing is you swallow it. We have a case on one payment that it's been 9 months since we have asked for it to be resolved by the large bank. And in the meantime, it's the consumer that gets hurt. And so at the end of the day, it's all about the consumer and how we protect the consumer in the payment systems. And how do we also meet their needs? And currently, I don't think their needs and desires are being met. But I know that a lot of folks have some comments on that. So Anita, why don't we start with you?
Thank you, Carlos. Sorry, my video is a little delayed when I try to start it. I think one of the questions that we had received as part of the agenda was really looking at implementing real-time payment solutions like FedNow. We currently do not offer Zelle at our bank, which, to be completely honest, I'm glad that we had made that decision due to the amount of fraud that has gone on in that payment app. But I think as we are looking at the implementation of FedNow, which we do plan to implement to be a receive-only bank at this point, but some of the concerns about being a send bank, which obviously we need institutions to be send institutions too, otherwise it doesn't really work. But there's still a lot of unanswered questions, I think, from the community bank industry, especially considering how fraud is going to be looked at if these payments are instant. How is, when a consumer comes back and says, well, I was duped into sending somebody a payment, we can't really force that back on the other bank, is from my understanding. So that is one area that I think is a huge concern. There's also a lot of concerns, at least from my standpoint, as liquidity has tightened, about how liquidity is going to be handled as payments are going back and forth, especially during the weekend or overnight. How are we as a small bank going to be able to monitor that when we make a decision whether or not we have to sell Fed funds or purchase Fed funds, by a certain time frame with our correspondent bank on a business day? So there's concerns there too, with how fast payments are going to be moving, especially in light of the bank failures that had liquidity issues this spring. Just by social media, how fast payments went out of those banks. I don't really foresee, I guess, a bank run necessarily, but you don't also, having an overdraft at your correspondent bank or at the Fed is a major issue. So those are all things that right now, there's also a cost to us. It doesn't seem that we can really pass that on probably to our consumers. Those are questions that feel a little unanswered at this point. So to jump right into full-on real-time payments, I think, is concerning for a lot of smaller banks. Just to touch too on the Reg E disputes, I think Carlos kind of mentioned that, but I feel that there is a concern with that as well. I mean, we have actually had instances of what I would call friendly fraud, where our customers are coming in and asking us to, refund, or they're disputing a Reg E type transaction, but it's really not because it's unauthorized, but when they look at their account, they realize they're going to be overdrawn based on that, even though from a debit card standpoint, we cannot charge for those. That I see though, if we start to be held accountable for any sort of fraud in these payment apps like Venmo or Cash App, could really increase that friendly fraud area. I do want to commend the CFPB for starting to level that playing field by saying that they're going to subject those big tech companies to the same supervisory process that we go through. I think that will be extremely helpful. But those on the payment side of things are things that we're all focused on and wanting to make sure that we do right by the consumer, but also protect ourselves to be able to limit fraud and stay in business through liquidity. Thank you.
Thank you, Ethan. Ignacio, I know that you said that you were not into the Fed now, et cetera, but do you have any comments on payments in general? Let's come back to Ignacio. Derek?
Carlos, thank you. At DR Bank, we are also in the process of standing up the Fed Now, also as receive only to start. And I don't have anything to add to the comments that Anita made. I feel that she hit it spot on, and we are investigating, the same risks and evaluating what controls we need to have in place, and also just working on educating our customers, getting used to this new form of instant payments. A lot of our customers have never used Zelle or instant payments before, so we have a little bit of an education piece that we need to also add as we transition to that service.
Thank you, Derek. Victor, do you have any comments you'd like to make on this?
Sure, yes. Beneficial State Bank is currently not offering any instant payments, but we will be in 2024 with the advent of a new core system. But we are also very careful and aware that there is a fraud happening with these instant payments. During my discussions with some community members that are now very used to using Zelle and Venmo, and I think this actually had increased the utilization during COVID. So people started to feel more comfortable, more used to using these apps. We've seen a lot of small business, I would call them micro businesses, who are using these services on a daily basis. But there's a lot of fraud. One community contact mentioned that their nonprofit organization was a victim of a $6,000 of withdrawal from their account when somebody was going to make a donation, asked for a quick $1 deposit to verify that that was the right account, and the fraudster on the other side ended up withdrawing $6,000, and they fought tooth and nail to get that money back from the bank, and they were not able to. So I agree with the previous comment that education is a very important concern and need to help people understand the different types of payment programs that are available and some of the issues that they need to be aware of in terms of the risk involved.
Thank you, Victor. Jennifer, some comments?
Thank you, Carlos. So we at this point are not yet going into the true real-time payment space. We currently offer Zelle for our customers, our consumer customers, which seems to meet their desire for faster payments, but we haven't had much interest from commercial customers in a real-time payment solution yet. Even when we introduced same-day ACH, there really wasn't any demand and still isn't any demand for it. So despite that, we do anticipate that at some point we will have requests to institute a true real-time payments option. So we have been doing considerable research into the feasibility of adding real-time payments, either via the clearinghouse or FedNow. I've talked about this with other community banks in our area. I'm also a member of a regional payments association that is heavily involved in the real-time payments conversation. I especially would like to thank them for their contribution because they shared feedback from their membership as well. So in my opinion, what it comes down to in terms of obstacles for community banks to consider real-time payments, it's cost, third-party management, and fraud risk. So cost right out the gate is one of the biggest issues that we face. Even though FedNow has been promoting that they're offering very reasonable transaction fees, the cost to create an interface that allows our customers to actually utilize real-time payments is significant. I believe Sergio mentioned this in his comments, that as a small institution, we are tied to our core provider offerings. I'm also glad Director Chopra brought up core providers because that really is a case where community banks' hands are tied. We are so dependent on them to do the things we need to do that we don't have a lot of other options. When we investigated the possibility of adding a real-time payment solution with our core provider, we were quoted costs of between $60,000 to $80,000 a year just to have it. And that doesn't include the additional staffing costs that we might need because this has to be managed 24/7, 365. Doesn't include the additional technology costs we would anticipate from our service provider to maintain our network so that it can continue to function and provide updates to keep this system active. And it does not include the cost of additional fraud management software. When we talked about this I've actually had a conversation with someone from the Federal Reserve about these additional costs. The conversation generally turns to fintechs. They are encouraging community banks to look at fintechs as an interface solution if the core provider is not providing something that's affordable. However, that brings me into the second issue, which is that third-party management. So as a small institution, we do not have the staff to manage and properly investigate and monitor a fintech who has not been completely vetted. And so the risk we take in working with a fintech in this space is significant and would make it very challenging for us to go that route. And third, and most importantly, and you guys have talked about fraud already, but fraud risk is truly the biggest risk I feel in this scenario. We've talked about being a receive-only bank. However, I still think there is a risk of fraud in that situation too. New account fraud, money mule fraud, account takeover, identity theft, all are very valid things that could occur if someone learns that we are a real-time payment receive bank and they know they can get the funds and walk away with them. And in the end, that's going to result in a major loss to our institution. I do also want to speak briefly to Zelle and the fraud. There's a conversation around fraud related to Zelle, and I think we need to be careful how we frame the type of fraud that we're experiencing as an institution. Anita talked about friendly fraud. We are also seeing a lot of cases where it's truly a scam situation as opposed to an unauthorized situation. So consumers do not always differentiate between I authorized this payment and I didn't get what I asked for, or the person was defrauding me, or someone got access to my app, to my account, and did the transaction on their own. And I think we have to be careful that we don't shove the liability for the fraud in which the consumer was active back onto the institution. We do as much as we possibly can to educate our customers about looking for red flags in transactions that they do, about doing purchases over social media, about any deal that sounds too good to be true. But even with that, you all know the fraud is rampant. But if that gets pushed back onto institutions, the liability for those types of frauds, that again is going to cause significant losses that could theoretically, depending on the size of your institution, put you out of business. And thank you for the opportunity to talk about that.
Thank you.
Carlos, is it okay? Can I jump in? I actually moved to the room next door because I was having bandwidth issues. So that's why you see a new background. But let me share a couple things. I think Anita mentioned the issue of liquidity and, you know, having to think about this sort of round the clock. One of the things to me, which I think about quite a bit, is there are a lot of benefits of real-time payments, but really from a consumer's perspective, what are the things that they're trying to solve that they can't solve now? And I think Ignacio was the one who said, if I'm not mistaken, you know, we don't want to get into that. In many ways, you are already in it because you have probably so many of your customers that are using Cash App, Venmo, others. You are not really able to gatekeep on that. And in some ways, I think someone else mentioned understanding how they are policing fraud, errors, and others so that it is not pushed, you know, just on the bank. We're putting quite a bit of thinking into that. The second thing is, you know, I've wondered how community banks who are implementing it, how are you thinking about limits? So obviously there's a set of differentiation in caps in how much people can send outbound. There's all sorts of ways that people are thinking about managing this. But, you know, that's obviously a big question on the table about what are the speed bumps, what are the limitations that are put involved in this. And then just one or two other things, which is I think it can be a real challenge when the network rules. And, you know, let's be honest. Yes, the Fed is creating Fed now, but much of the payment networks is really in the hands of the industry. And that is governed by a set of industry-driven network rules. We've been sharing with Nacha and others trying to understand where they're moving and thinking about, and they have put out a proposed framework they're collecting comment on about things they're thinking about. But, you know, if you look at Zelle, Zelle is owned by the largest banks. So in many ways, smaller players, you know, will have less governance ability to shape the governance of it. So we're also trying to think about what is the ways in which this will work for all participants, you know, not just some. I forget which of you said this. I think Jennifer might have mentioned the issue of core service provider chargebacks to the institution. And I know a lot of us wonder whether those charges are really commensurate with with what service they are providing. But I think it's something, Carlos, I think in general, you all should be putting some thought into that because I think, look, I get it. You all will make business decisions on digitization. I think the cat is out of the bag that your consumers are going to demand it over time. And how will you be able to stay competitive with that? And how will we make sure that, you know, the regulators, the Federal Reserve System, everyone is supporting you in that? So Carlos, sorry, but I just wanted to react to a couple of points there.
No, we appreciate that. And one of the risk factors that we haven't talked about, but one that should be in the mind of the CFPB is the so-called forced debits. When a consumer does a debit card transaction and there are insufficient funds and transaction is not approved, certain of the large merchants have relationships with the payments providers, and they force the debit through, causing an overdraft to the consumer. The consumer has said, no, I'm opting out of that. So that's an area. But I did want to give Bruce a chance to make any comment that you have as we are down to 3 minutes.
Thanks, Carlos, but we just don't do enough card activity to where, you know, I don't know enough about it. I agree with what people are talking about with the risks associated with it. And it probably going to be a while before we do anything like that.
Okay, well, thank you very much, all of you, for your comments. And Director, it's on you. Appreciate some closing remarks.
Great. Yeah. No, well, I think this is a really great initial discussion. So the themes that I think we have covered a little bit is really what is the nature of the economy and how are consumers faring in it. I think we're going to need all of you to tell us where is the places that CFPB should prioritize and focus on. Two, I think we touched on a number of things about the role of community banks in the broader competitive set for consumers. Credit cards was mentioned, payments, mortgage, others. I think what I'm going to ask each of you to do is share with our staff and Carlos what may be some areas where we can work in smaller groups to develop some more thinking and maybe even some action items for the CFPB and others to move on. And then in general, I want you to think of other places where you think we might want to have further discussions about the future of community banking, the sustainability of community banking. And do please keep thinking about all the ways that we might make sure the system is inclusive, serving everyone fairly, and that we'll be able to meet the ongoing challenges no matter where we are in any economic cycle or interest rate cycle. So Carlos, Manny, I'll turn it back to you, but I know we are also thinking and brainstorming about ways we can physically be together without any tech challenges. But I again want to appreciate and a special thanks to the new members who have joined our discussion. And really great to see people from across the country, urban, rural, and everything in between.
Thank you, Director. I now will give it to Manny. You can close it. Thank you.
Thank you. Yes, thank you, Carlos. Thank you, Director, once again for making time, and certainly thank you to all CBAC members for joining us today and providing such valuable perspectives to the CFPB. Your insights are always appreciated. With that, we can wrap it up. Tracy, we can adjourn at this time.
Thanks, everyone.